When conflict erupts in a major geopolitical choke point like the Middle East, the physical effects do not stay localized. The disruption instantly ripples outward, throwing global energy markets into periods of extreme price volatility and fragile supply. For Australians, that global turbulence translates into an immediate hit to the wallet. We see it the moment we pull up to the petrol pump, with sudden spikes in the cost of unleaded and diesel fuel driving up the baseline cost of everything we do. Yet here is the contradiction. Australia sits on massive reserves of natural gas. We extract so much of it that we rank among the largest exporters of liquefied natural gas on the planet, loading colossal ships to power trading partners overseas. We ship out raw energy by the ton, but we rely almost entirely on foreign imports for the refined petroleum we actually use. To make matters worse, the gas we do keep onshore is pegged directly to international export prices. When global markets panic, Australians get squeezed from both sides, paying inflated import costs for liquid fuel and inflated export rates for our own domestic gas. This extreme exposure to overseas turmoil is not a geographic accident. It is the direct result of policy choices that allow private firms to extract maximum profit from a national resource, leaving the domestic economy completely unprotected from global shocks. If you listen to the debate in Canberra, the proposed solution to this crisis sounds perfectly reasonable. Politicians argue that we need to tax these gas corporations just a little bit more to raise the revenue required to balance the budget and fund cost of living relief. This logic treats the Commonwealth as though it were financially constrained, like a private household, suggesting that the national government must collect Australian dollars from the private sector before it can spend them. Australia is mismanaging a multi-billion-dollar strategic resource because our leaders are playing by a set of rules that don't actually apply to a sovereign government. As long as the public and policymakers believe the federal government is broke and relies on corporate tax dollars for its survival, private corporations will keep extracting extraordinary windfalls while the public interest remains secondary. Australia has two economic rulebooks. States are currency users. They must collect revenue, like royalties, before spending. The federal government is the currency issuer that creates the Australian dollar. It generates money at any time, completely independent of inbound revenue. If the national government can always create the currency it issues, then taxing gas exporters has nothing to do with finding cash to pay for government programs. Think of a federal tax as regulating the ceiling. When shocks create massive price spikes, an effective tax slices off that excess profit. Wiping out these windfalls cools inflation and builds a floor, shielding households from extreme costs. Other currency-issuing nations already operate this way. Norway, for example, applies a punishingly strong rent-based tax to its petroleum sector, ruthlessly disciplining excess profits generated by global scarcity rather than actual productive effort. Leaving federal gas taxation at these current, low levels represents an abdication of the government's role. It fails to regulate the economic ceiling, allowing private windfall gains to accumulate while the wider public absorbs the inflationary damage. The federal government will never run out of Australian dollars. What it can run out of are real resources. You cannot conjure skilled labor, engineers, heavy machinery, or raw materials with a few keystrokes. Our current system incentivizes the growth of sectors that harvest national income without adding to our real output. We see talent and capital flowing into brokerage, asset churn, and the tolling of existing wealth, activities that extract income while leaving our actual productive foundations to wither. We can see the physical consequences of this parasitic drain. Because our workforce and investments chase paper profits, Australia has neglected its actual heavy industry. We lack sufficient domestic refining capacity, resilient supply chains, and the strategic fuel storage required to weather a crisis. No amount of government spending can save an economy if its physical capacity to make, move, and secure essential goods has been hollowed out by financial extraction. Temporary measures like fuel excise cuts only subsidize a broken market. To fix the underlying structure, we must implement aggressive, rent-based federal taxes that crush conflict-driven corporate windfalls exactly where they start. If the national government wants to bank the wealth generated by our resources, it cannot meaningfully save in its own currency. It must save strategically in foreign currencies, securing the external purchasing power we need to guarantee access to critical imports during a global shock. Ultimately, if private logic cannot deliver domestic security, the Commonwealth must look to stronger interventions. That means enforcing strict domestic reservation, taking majority equity, or returning to public ownership. Natural gas is a finite national asset. Until Canberra stops acting like a stressed household and starts acting like a sovereign currency issuer, Australians will continue paying the price for a deeply flawed economic story.